Hello, everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. Welcome to the show. And we are going to enter, finally, after a slow start to the week, the interesting portion of the week's macro programming. We are looking here, of course, within the next 24 hours at a pair of key releases that will motivate the market's thinking one way or another around the key narratives that have been formative for them in the past several weeks and months. And so what we're going to do here is jump in, take a look at what those might be, inspiring here, how they might move markets, and the extent to which we could be sitting here on an asymmetric kind of opportunity, whereby we could be sitting at a trade setup in risk sentiment and its reflection in both stocks and the US dollar that's not just formative, but that the markets aren't necessarily priced for yet, and which could thereby create a bit of volatility. So, needless to say, the first thing first here is to look at expectations and to look at what's actually coming out. The data focus, not surprisingly, to be sure for all of you, is going to be the March CPI report. We're looking for the month-on-month gain of 0.2%, so a slowdown. The year-on-year number coming in significantly from 6% to 5.1% if expectations hold. The core, a little bit more durable. The slowdown on the month-on-month level more modest, 0.4% versus 0.5%. The year-on-year number actually registering a little bit warmer, 5.6% if expectations hold. The other bit here is going to be the release of minutes from the March FOMC meeting. This should be a critical bit of context, because what we get here is a relatively unique lens into the Fed's thinking through the outbreak of the banking crisis that we got struck with at the beginning of last month. At the time, of course, the Fed was in its blackout period before a policy announcement, so they couldn't actually opine directly. Of course, we've since had that policy announcement, and they opined then, with some benefit of removal from actual events, with the benefit of having seen that their actions were successful, and the Treasury's actions were successful, and FDIC's actions were successful, at least for now, calming nerves. And so what we haven't seen is what the tenor of the conversation was at the time. Now, of course, the minutes are going to be a massage document. This is not exactly a verbatim retelling of what was said at the policy announcement. We're not going to have in the document some sort of a Jim Bullard jumps on the table and starts throwing coffee cups kind of situation. But it is going to be an interesting window into what the Fed was saying when all of this was going on. And of course, we know that at the time, we couldn't hear it, but subsequently, the message was, this is episodic. We can run managing whatever issues at the banks in parallel to managing inflation and the rate hike campaign. One does not necessarily trade off with the other. So we can pull liquidity from the economy as a whole, even as we direct liquidity into troubled banks. So we know how the Fed has ultimately decided it wants to approach this. What we don't know is, how did the Fed think they would need to approach it as it was occurring? And did they foresee that continued issues would be something that could put the brakes on tightening and even create some degree of easing. We, of course, know that as far as the markets are concerned, that's exactly what's likely to happen. But the markets continue to expect the flip in the policy cycle and the start of easing later this year, which we'll take a look at in just a second. That clashes with what the Fed has said. At that policy announcement, Fed Chair Powell very clearly made the point, albeit at the end of his press conference and subsequently left very quickly, whatever that means. He nevertheless said policymakers are not looking for cuts this year. And so the contextualizing of CPI and whatever it shows with whatever the minutes demonstrate the Fed's thinking looks like and has evolved into should be very interesting for all of the major moving parts of what we're looking at. Now, one important thing to note here is, of course, U.S. economic data tracking inflation measures, this is focused on inflation numbers specifically, has been trekking lower thanks to the Fed's tightening efforts. So we can see here very clearly that the sort of chorus of economists and chorus of market participants that tracks markets and creates expectations has seen their models generate inflation numbers that reality does not endorse. That essentially realized outcomes have skewed away from inflation registering higher and skewed on the lower side of things. That trend continues, suggesting that these models are yet to be updated. They still continue to overstate what reality has thus far endorsed. And so we do in that see capacity for more of the same. Looking at some of the leading indicators from the data that we saw last week, we can see that the ISM Services Price Index tends to seemingly lead CPI by about 3 months and lead PCE by about a 2-month lag. What we can see here as well, though, is this is not a one-for-one kind of thing. Inflation does seem to be generally indicated higher, but there are certainly instances where these things diverge. There are certainly instances where CPI, let's say, or PCE ticks higher, and I'm looking at May, June area near the peaks here, where ISM was leading them lower, but they ultimately didn't go that way until later. So it's certainly within the realm of possibility that that doesn't imply that we're going to get a softer number on this release. But the general trend does seem to point toward continued disinflation. Something similar comes out of the jobs report that was released on Friday. And we'll spend a little bit of time here because this actually was a very interesting jobs report in terms of its consequences. But here you can see average hourly earnings leads CPI by about a 3-month stretch. And here we seem to have continued indications of disinflation. So there appears to be a sense that we're biased lower in that average hourly earnings tick down to 4.2%. What's critically interesting about this NFP report is that despite this downtick, despite average hourly earnings slowing, wages growth slowing, the thing that the Fed is most concerned about, slowing. Despite that, the response to NFP was a stronger dollar, higher yields, weaker gold, weaker indications in the stock market. The stock market itself, of course, couldn't react to the data per se. It was closed for the Good Friday holiday. But in those places where we had spot markets open, the situation looked like it was broadly negative for risk, positive for the dollar, negative for gold. We saw at the open this week that the initial response from ES futures, the S&P 500 E-mini contract, we saw that initially register negative until, of course, intraday it flipped and gave us a flat result, which is, of course, where we continue to idle now. We're essentially unchanged on baseline S&P 500 levels since Thursday last week, before the jobs report. But it is certainly eye-catching that even with this softer wages number, we nevertheless got at least one rate cut slated for the back half of this year, shaved out of the outlook. And the reason is perhaps that the numbers weren't as bad as people were primed to see. Going into that release last Friday, we saw job openings undershoot expectations. The JOLTS number under 10 million for the first time in a long time. We saw the ISM component of the pricing picture for services and manufacturing, and the overall numbers, including for labor, including for new orders, including for the entire set of figures averaged into the headline number. All of those things weaker than anticipated. Jobless claims worse than expected. So the markets were seemingly primed for a recessionary type of jobs report and plainly didn't get it. They got a jobs number that was pretty much in line with expectations. The expectations range from about 230 to 240. The outcome was 236. The unemployment rate even ticked down a little bit to 3.5. So it seemed like we saw a situation where the market got an inline response at a time when it was primed for something negative. It didn't really move the needle on rates going higher near term, but it cut out the extent to which they'll go lower thereafter, at least this year. And that seemed to be market moving, at least to a modest extent, amid thin liquidity. And this is where these releases coming up become really interesting. This is where CPI has the potential for movement, and especially so with these FOMC minutes as added context. If we look at where we are on the relationship that we often look at between the 2-year break-even, which is the market's priced-in inflation expectation implied in bond yields, if we look at that and we compare that with realized inflation readings, you can see, as we have so often on this show, this is an indication that we go back to all the time, there's about a 2-month lag where expectations lead realized results by about 2 months. And this, of course, makes sense. The markets are, by their very essence, forward-looking. And, of course, the break-even number is a real-time moving gauge that gives us an indication as markets move, whereas the PCE and CPI numbers that we see here are monthly figures. There's, of course, a lag in data collection, data publication, and so they tend to lag behind, even though they are on top of that, reflecting something that the market is already anticipating at the time they even begin to be put together. So not surprising that there's a degree of of lead on the expectations side. And what you see here is that we are maybe in the final stretches of a decline in inflation that expectations would have projected, but going forward, there appears to be a reacceleration. We can see a 3.2 figure there anticipated as a signal for where CPI might go next month. The month after that, we can see break-even rates for March and now April hovering at 2.7%. That's closer to 3 than it is to 2. So what we're looking at here is the market saying to the Fed, with everything that the bond market takes into account, with everything that they've considered in pricing these assets, it looks like the Fed is under-tightened, not over-tightened. And that's something that presents a really stark contrast with what we're seeing in markets because, of course, this is another chart we keep going back to looking at. Since the SVB episode, where you can see here the 12-month Fed funds future outlook that basically tells us where Fed policy is going to be a year from any given point in time, that hasn't really recovered after a crash. Whereas worries about financial stability have clearly receded. The dark line there, the OFR Financial Stress Index, that's something that's put together by the Office of Financial Research within the U.S. Treasury Department. You can see there that's cooled quite a bit, maybe about halfway of the spike, despite the fact, by the way, that vulnerabilities clearly remain, as we talked about on this show before. But the Fed rate hike outlook hasn't really budged. And so when you look at that in the context of this, it does kind of beg the question. If we are seeing the washout in Fed rate hike odds here because of the SVB episode, and leading into it, they were actually on the incline, what has changed? Well, SVB risk seems to have changed, or post-SVB and SVB adjacent risk, let's say. Banking crisis risk, that seems to have changed. It's gotten better. Has the economy really moved that much? Has it been altered all that dramatically? Well, perhaps not. Certainly doesn't seem like it's been that dramatically impacted. U.S. economic data, as we just mentioned, has become a little bit more soggy, but not catastrophically so. And so these rate hike odds not moving is a bit of a disconnect, and perhaps the reason why we get these warm break-even readings and the possibility for an upside surprise. Looking at the way that the yield curve has behaved, we can see that over the past week, thanks in part, of course, to that NFP number, actually crept a little bit higher. So we now see a 5 handle on the terminal rate being hit essentially by next month. We can see that holding through to maybe July, and then the rate cuts come into the picture come September, November, thereafter. You can see there the process starts to accelerate fairly quickly into the back half of this year and going into next. But it is certainly interesting that we are still as downbeat as we are relative to where we were before the SVB collapse. You can see that curve there in the small dashes with a terminal rate in the vicinity of 5.5%. It is very interesting that that's where we still are, because ostensibly the level of concern about that risk has eased more than Fed rate hike odds have adjusted for that easing. And so we then have, perhaps, a situation where someone is wrong. Either the rate hike odds are wrong, or the sense that risk is easing is wrong. But one way or another, if we get a CPI number here that flags movement off this square one way or another, we might be looking at a market that's priced for something that isn't sustainable. Now, looking at where rate hike odds are at the moment, here's what we can see. In May, we are currently priced for about a 71% chance of a 25 basis point hike. You can see that in the percent hike cut column. 71.4 reflects, looking over to the implied rate delta column, 18 basis points of a 25 basis point hike already in. Then when you look at June, you can see there is an 80% chance of a hike relative to current rates by then. And there's another 9 basis points added into the mix. So you can see by then 20 basis points of a 25 basis point hike are baked in. That's the implied rate delta column. You can see that come July, we're already back to unchanged. Come September, we're at unchanged. Come November, there's a 66% chance of a cut at that move in particular, at that meeting in particular. But when you bake into that the slight chance of a cut in September, you end up with a 98% chance of a 25 basis point cut, looking at the number of rate hikes and cuts column that you're seeing here. It's unclear where you're going to get that first cut, September or November here, but by November, it looks like we're almost fully priced to see it. In fact, 24 of the 25 basis points are in. Come December, we're now looking for almost another cut. This is, of course, different from what we've seen recently. We were looking at 3 cuts fully baked in as of about a week ago. Now it's maybe 2. So 42 basis points out of 50 already in the market. And this is where things get interesting. Note the evolving relationship between rate hike odds and risk. On the bottom there, you have the S&P 500 with the sort of darker brown dashed line, just a 5-day moving average to make things a little bit easier to gauge as far as where the trend is going. Then you have the current peak Fed rate odds meeting expectations, so June, and the end of the year, December, which you can see move in relatively close proximity. So what we are watching here kind of breaks down like this. You can see that the stasis in rate hike odds that you had from, let's call it November through January, was good for risk. Stocks were moving higher. We rose from, let's call it 3560 or so on the S&P up into essentially 4150 or so by the time that February rolls around. And then, of course, you can see in February, rate hike odds start to move higher. This is where you get up to that peak near 550 before SVB occurs and things collapse. Note that when you get that build, the S&P 500 starts to fall. So you get this typical response that you might anticipate, where the likelihood that you get rates higher than previously thought gives you a risk-off outcome. Then SVB occurs. And you can see that the correlation between rate hike odds and stocks actually becomes positive. So first, rate hike odds collapse, and the S&P moves aggressively lower. Then, as you see the S&P bottom and begin to recover, as officials kind of ring fence SVB, Signature, Credit Suisse gets their rapid marriage to UBS settled out there. So you get a sense that with the turmoil easing, stocks can recover, but also Fed rate hike odds stop falling and start to build back up. Not aggressively so, very modestly, but there's now a positive relationship here. And so what this flags is that one way or another, depending on what we're looking at for this CPI outcome, the relationship will either stay direct or become inverse. We've seen both recently. And it seems like we are going to need to thread the needle very finely on this CPI release to get what we're looking at here, which is stasis. If we get a CPI number that's relatively hotter, we could be back to where we were at the beginning of February, which is rate hike odds recovering and risk easing off. Because as we just saw, threats of a banking crisis seemingly have come out of the market to some extent. At least the worries have calmed, but rate hike odds haven't rebuilt, which means if we correct that imbalance in the direction of rate hikes rebuilding and catching up, could be a risk-off response. If, on the other hand, the CPI number comes in very weak, this new relationship probably holds. And we get a drop in rate hike odds, but with a decline in risk. And of course, what this captures is this US dollar smile dynamic that we've been talking about incessantly in recent weeks and months, which is that the dollar tends to do well at times when sentiment is at an extreme. So when, in this case, we're looking at a version of this in GDP terms, but of course, it's the thematics that matter. At times when the U.S. is aggressively underperforming the G7, the bigger the margin, the more acute the effect, the dollar is stronger because you get a flight to quality and a cashing out into what is the most liquid form of cash available. And of course, strange misinformation notwithstanding, nothing is replacing the US dollar as the go-to form of cash at any point in the foreseeable future, as far as I'm concerned. Things like that are impenetrably nonsensical in my view of it. The data is just simply not there to support any such thing. So, especially in a near-term sense. So, you have a situation where if there is a risk aversion outcome, if there is then a situation where either a strong number rebuilds Fed rate hike odds in a risk-off way, or a weak number undercuts them in a risk-off way, if there is a risk-off response, that has a tendency to be US dollar supportive. If there is an outsized risk response in a situation where the rate hike expectations are building higher, if the number is stronger, if, like NFP before it, it shaves more rate cuts out of the outlook, let's say, well, then you get to the right side of the curve, where the dollar's yield advantage propels it upward. And so, seemingly, the only way that this CPI number is going to give us a relatively staid outcome is if it sticks very close to expectations. If it doesn't veer higher or lower and force a reckoning with this and with this, with the idea that it seems like markets' inflation expectations are still not putting the Fed on target. And it seems like the Fed rate hike odds that might have been, were SVB not to have occurred, have not rebuilt. Even as risk of a banking crisis after that episode has significantly come off. So one way or another, whether this relationship is going to be direct or inverted, again, we've seen both versions. It seems the part of the financial markets that's most primed to benefit from any deviation one way or another, as long as it's a meaningful one, is the dollar, which is, of course, a very opportune sort of thing to find at a time when technically the dollar appears to be signaling that perhaps the next leg in its multi-year, at this point, over a decade-long rise might very well be afoot. You can see that for February's price action, this is a monthly chart of the Invesco US dollar ETF, UUP is the ticker on that. You can see we have a bullish engulfing right at support that was former resistance, capping the greenback, going all the way back to 0809. So if there was going to be the next leg higher, this is a very opportune place for one to start. And that is macro money for today. We'll of course, be back tomorrow. We're here Monday through Thursday every week after overtime with friend of the show, Chris Vecchio, head of futures and Forex here at tastylive. I'm also on with Chris on Fridays for Futures Power Hour, on with Tom and Tony for First Call on Sundays, and opining on Twitter when not on air at Ilya Spivak. Thanks very much for joining, everybody. Good luck out there. Talk to you tomorrow. Take care.